you're buying a home in Canada, or if you already own one, there's a number that is behind and impacts almost every financial decision that you can make with your property. Most people haven't really paid much attention to it, and the ones who have usually don't know what it actually means and signifies behind the scenes. It's called loan to value, or LTV for short. Here's what it is in basic terms. The loan to value is simply the ratio of what you owe on your mortgage and what your property is worth. That's it. So if your home is worth $800,000 and you have a $600,000 mortgage, your loan to value, or LTV, is 75%. You owe 75 cents for every dollar that your home is worth. If you bought with 5% down, put 5% down payment on a home that's worth $600,000, you put in $30,000 and your borrowed amount is $570,000, your LTV is 95% in this case. If you've owned your home for 15 years and you paid it down significantly and it's gone up in value, maybe you owe $300,000 on a home and it's worth $1.2 million now, your loan to value in this case is 25%. The concept here is the same, it's just different stages of the journey in these two examples. Now, here's why this matters. That number, your LTV, it determines what you can and you can't do with your mortgage. It determines whether you need mortgage insurance when you buy. If you put less than 20% down, mortgage insurance is required in Canada. It determines what rate that you qualify for, what tier you're going to be in. It determines how much you can access in the form of equity if you want to refinance to pull out some equity. And it determines which lenders make the most sense for you, depending, again, on how much you have down, whether you've got mortgage insurance and what type of mortgage that you have. I had a client quite a few years back, sharp guy, good income, solid credit. He'd owned his home for about 6 years and he wanted to pull out some equity to invest in a second property. He had watched other videos and he had read about this online. And he called me, he was very confident, and he said he had plenty of equity and he just needed me to make this happen. So when I ran the numbers, it turned out he had less room than he actually thought. His home had gone up in value, but so had his remaining mortgage balance because he had taken a 40-year amortization. So his balance actually, well, it hadn't gone up, but the amount that he was thinking he was paying off was a lot less. So when we calculated his actual loan to value, his LTV, he was sitting at around 78%. Now, the maximum LTV allowed on a refinance in Canada is 80%. So he had almost no room to work with at all. And what little room there was came with rate implications that he wasn't expecting. And we still found a solution, but it looked very different than what he walked in expecting. That conversation would have gone a lot smoother and he would have made a better decisions along the way. Well, it depends really, because I think the biggest thing in this scenario for him was he wasn't really versed on the mortgage paydown principles and whatnot. Know your loan to value, calculate it today, divide what you owe by what your home is worth and multiply it by 100. That's the formula. That number tells you exactly where you stand. In the next video, I'm going to show you how LTV actually affects your mortgage rate in Canada. And there's a twist in there that surprises almost every homeowner that I talk to. If you want to know where you stand right now and what your options look like, send me an email. We can work it out in about 5 minutes for you. If you found this content valuable, go ahead and hit that subscribe button. We're going to be breaking down more industry jargon and making it easier to understand. And we're going to go over other strategies that will help you become mortgage free faster. We'll see you on the next one.